welcome to another edition of Focus on Alternatives, sponsored by ADISA. I'm Damon Elder, the publisher of the DIWire.com, and today we're joined by Kevin Gannon, Chairman and CEO of Robert A. Stanger Company. Today we're going to talk about non-traded REITs, which, as I'm sure most of you know, Kevin is the authority on. So this is the perfect topic for him, and so why don't we dive right in, Kevin. Specifically, we're not going to talk about so much the past of non-traded REITs, but the transformation that we've seen over the last few years. So, of course, non-traded REITs were started in the early 90s, when they slowly grew in popularity. Ultimately, in the mid, 2013, 2014 or so, especially once ARC had come on board, Nicholas Schwarz's ARC, we saw equity raise get up to about $15 billion, I think a record around 2013 or so. Then, of course, we saw FINRA's 1502 and the ARC implosion, and equity raise plummeted to about $4.5 billion per year for the next 3 years. And then, just a few years later now, it's going to be, according to Robert A. Stanger Company, you're projecting an equity raise of about $35 billion this year for non-traded REITs. How did this dramatic transformation happen?
Well, I think fundamentally what happened was there's a big transformation of the product style, right? We now have non-traded REITs that are very transparent in terms of their disclosure, right? We know what the NAV is every month. We didn't know that before, Damon. We went for years without knowing what NAV was. Now we know NAV every month. We have a good dividend level, a good dividend yield, and we have great sponsorship. We have sponsorship by the likes of Blackstone, Starwood, Nuveen, KKR, and others. Don't mean to leave anybody out, but there are some great sponsors that have entered this space. And on top of all of that, we've got a product that delivers a liquidity element, right? We can get up to 20% of the equity out of these things every year by the way they're structured. So that confidence in the liquidity has been a big game changer. And then the last piece is what should be the first piece, which is performance. Performance has been excellent, right? We've seen the performance of the non-tradeds. We and another trade organization sponsor a monitor, and that monitor tracks the performance of these deals, and they're outperforming the traded REITs, which I think drives the traded REITs a little crazy, but it's been much more stable. So you got performance, liquidity, good sponsorship, and transparency, the makings of a great industry, really.
So you mentioned Blackstone and some of the other really large institutional players who've come into the space. Blackstone, of course, is singularly the behemoth in the room, the 800-pound gorilla, raising somewhere around 2/3, I think, of the equity in the space. But others are growing, like you mentioned, all these other institutional players. Starwood's really having some real success in the last few years. What are the institutions doing differently? How have they transformed the space fundamentally?
Well, I think they're bringing a great and broad perspective on real estate, right? When we talked with John Gray when he first came out with Blackstone, we said, okay, so what are we going to buy? What are you going to do? It's different. And he said, well, I'm going to focus, my high conviction assets are going to be those things we think are going to really grow the next 5 years. And so they focused on apartments and logistics/industrial and some net lease versus the old style was more office, some healthcare and retail, right? So he stayed away from those asset classes, which were, I think, quite smart, and everyone else followed suit, and it's turned out to be a great play. So I think that research and knowledge about real estate, that broader perspective on real estate asset classes, big game changer, I think. In the old days, as you know, we focused on generally singular asset classes, which is how the public REITs are structured. In this business today, it's mostly diversified. There are exceptions. Ares and Black Creek have an industrial program, which has done really well. And
you got to be in asset classes the last several years. Industrial and multifamily has been a great place to be, right?
Great place to be. The performance has been great because of the morphing out of retail, right? Morphing out of retail and the work from home thing, which has bitten the guys who had a lot of office. So we think that's going to turn around as these cycles go. We think there'll be some recovery, but at the end of the day, they picked the right asset classes, and they've also picked things like self-storage, right? And a few others that have done quite well. We like it in everything in a little bit of moderation, but multifamily and industrial was clearly a game-changing focus for the space.
So rightly or wrongly, fairly or unfairly, for years, non-traded REITs were criticized for having unduly high REIT or fee structures for investors. How have the institutions, how are modern non-traded REITs approaching fee structures? Have they moderated in real terms, or is it just, again, you're attracting a different class of investor, a different class of sponsor?
Yeah, I think a couple things to answer that. One is the front end load's different, right? It's structured differently. It's lower, generally speaking, and it's paid differently. You either sell iShares, about half the space raises money in iShares. So,
and those are for institutional type investments with really no load.
No load at all. It's usually dropped into a wrap account, and they collect their fees from a financial advisory perspective out of the wrap account. And then there's other classes that have a 2 to 3% load, which is added on top of the purchase price. As you know, in our space, we constantly dragged the 10% load with us, and that dragged on your performance. Now it's added to the top and comes off as a commission and kind of forgotten about ultimately in terms of the security. And the rest of the load, if any, is a servicing fee that's paid out until they hit a threshold of like 8 or 8.5%. And again, it's more accepted. It's paid out over time, and it's not the 10% load up front that usually startled everybody. With that change, it changed the perception of the space. Now we don't get the punches in the nose. I took the punches in the nose for the space for a lot of years, and we explained how it was different. But now with the performance measured the way we measure it, it's really a big change, The rest of the fees they charge, Damon, are, one fee they don't charge anymore is the dealer manager fee to the sponsors managing broker dealer. That comes out of the sponsor's pocket. That used to be 1.5 points that covered that cost. They don't get that anymore. It takes a big boy to play in this space because that cost is pretty substantial. Secondly, the fees they take are usually 125 basis points on NAV, plus 12.5% of total return, subordinated to a 5, but a full catch-up inside the 5. So they can be tasty, but you must hurdle the 5, and you need appreciation to make that happen. Again, I think that it's more aligned. I think that fee structure is more aligned with the investors than it was in the past.
And like you said, performance pretty much trumps anything, and you've seen
so.
Good performance. What, generally speaking, I know you don't have maybe the numbers right in front of you, but generally speaking, over the last several years, what have the NAV REITs been returning to the investors?
Yeah, up till this past year, it was about 7%, 8% was typically an annual total return, dividend and appreciation. This past year, it's been 15 to 20 because they recovered from that. We had a little dip in the first quarter of last year with COVID, and these guys stepped up and they took their hits, and everybody said, well, let's see how that plays out. And most of them by end of the year had recovered and done well. The other thing more amazing, I think, and the real bellwether of this space was them meeting redemptions. When the redemptions kicked in Q1 of last year, everybody said, well, what are they going to do? And some of them hurdled their 2% monthly cap, and they stepped up and met the redemptions. And I think that eased the tension.
Well, and we really didn't see any closure to the redemption programs. I mean, like you said, they really pretty much stepped up and fulfilled them.
Correct. But even when they hurdled their 2% cap, they didn't gate anybody.
Right.
They met the redemptions. And you know what? That put everybody's mind at ease. And I think that was really probably the best thing they could have done, even though it cost them some of their capital. It was a smart thing to do. It was not smart, it was brilliant, because everyone was calling me, what are they going to do, what are they going to do? And I said, well, we'll see. But they stepped up and met it, and I think that calmed everybody down. And it's done well as a result.
Why are the institutions chasing the retail dollars? I mean, it's a much less efficient way of raising capital for them, certainly far less efficient than they're typically used to in raising equity. Why is there such interest from all these big institutional players in coming into the retail space now?
Well, I think there's a swing of how capital gets raised institutionally. Institutions typically drive a harder bargain on fees. The fee you see in their offering document isn't the fee they pay. They have a thing called side letters. Every investor gets a side letter, and the fees get chewed up a little bit. And so that's a challenge. And usually they're finite life, right? These are perpetual life vehicles, right? Which is a big attraction. And it feels like a stickier source of capital. People put their money in, they're making the conscious decision to invest perpetually, probably got a 10-year horizon, probably. So that feels pretty strong and something that they are looking for, and the fees aren't bad. 125 basis points plus 12.5% total return. Last year, Blackstone, I don't want to be picking on Blackstone, but they paid almost $400 million in total fees out of one deal. Yeah. So that got my phone ringing off the hook. Everybody's calling me, thinking that, well, we can't be Blackstone, but a small piece of Blackstone would be something interesting. Yeah, so I think it's interesting, and plus I think they like the IQ of the product now. The IQ of the product is a big deal, right? We for years we were always looked at as a kind of a secondary type of investment. Now it's a primary major league investment now, and I think that it's something that everyone thinks is a good alternative to the traded REIT space. We'd never say that traded REITs are not good investments. They are good investments. This is a good complementary investment. And
they're fundamentally different, even though they're very similar, right?
Yeah, the traded REITs call us now. The traded REITs call us. They want the lowdown on how's this working. Right. Explain this to me. Can we do one of these, right? They're asking that question. And monster, $50, $100 billion traded REITs are asking about coming into this space. I don't think many of them will come, if any, but there's that much interest where it's exciting because the capital formation is so great. Damon, as you said, $35 billion this year in non-traded REITs. The other alternatives we track is another $35 billion. $70 billion coming in
real money
to our space is pretty sizable. And as you point out, our peak year previously was 2014, and it was like $19 billion. It was about $19 billion, and a big year, and that was without the wires.
That was a record year, yeah.
Yeah, that was without the wires.
Well, so you bring up something else I wanted to talk about. So that seems to be another fundamental shift that we've seen once the institutions came in. Even prior, we saw, really LaSalle came in many years ago and have slowly built up their non-traded REIT, and they started to bring in a lot of wire money. Blackstone obviously is raising, I think, most of their equity through the wirehouses. What are we seeing equity flow wise? Traditionally, non-traded REITs raise their retail capital through registered reps, broker-dealers, et cetera, RIAs to a certain extent. But now it seems like we're really starting to see a flood of equity coming in from the wirehouses. Is that true? What kind of percentages are we seeing? What from your insight?
Our estimate is about 80% of the money's coming through the wires, and about 30% of that is coming from overseas. So they're able to source the capital from overseas now, and so it's an international product now, where you wouldn't have thought of that like that, this product like that previously. So having that kind of source of capital is intoxicating, I think, to some of them, and it's a great opportunity to get out there and build your AUM up. Like we said, Ares has come in, Blackstone, KKR, Starwood. It's a good list of sponsors that. It's an upgrade. It's an upgrade to the sponsorship of our space. Nothing wrong with the old line sponsors, the Inlands and the Griffins. They're all great companies, but these are some institutional sponsors. So.
Are you starting to see, because of the wires growing more familiar with the non-traded alternative space, that maybe we're going to start to see more inclusion among the wirehouses and some of the other types of alts that are out there?
Sure, you already see it, Damon. You see it with the DSTs. The DSTs, the wires have caught fire with the DSTs.
Black Creek has a wire.
Black
program.
Creek and there's a couple others, and the folks at Cantor have one. They're not in the wire, but they have a product that's linked up with their non-traded REIT, and the idea is. Let's capture the capital on a 1031 exchange and then roll it into a permanent, perpetual life vehicle. And that guy's going to probably stay until that family member dies, because he can't 1031 out of that anymore. Right. But it's a diversified, rather than being in a single asset, he's in a diversified pool. And so I think you're going to see a lot more of that coming down the pike here in our space.
So it's really been a complete sea change in really a dramatically short period of time. What's coming? What's ahead? You mentioned you've fielded some phone calls from publicly traded REITs who may or may not enter the space, but what else are you seeing? What are your predictions for the next several years in the space?
I think you're going to see a lot of other asset classes come this way. You already have the Stepstone deal, which is a private equity deal. right? And so you and I can, for 50 grand or 100 grand, can buy an interest in a private equity deal where ordinarily we'd have to put up $500,000 to do that, right? So we're going to have exposure to that. We think that's big, and it's coming down the pike here. They've already got an effective deal, and we see others lining up to do that. You're going to see more BDCs, right? You just saw Apollo file, right? And Apollo is a big player.
Another big name.
Another big name coming to our space. They tried to come in a few years back. They tried to buy ARC, right? They tried to buy ARC.
A few things happened there.
Right, right at the right time. And at the end of the day, we're going to see more players like that bring a broad array of good, legitimate, institutional quality product to the retail investors. And we owe it all to the guys who started this momentum, the WP Careys, the Leo Wellses, the Inlands, the CNLs of the world. Those guys were the pioneers, right?
Who'd have thought 30 years ago what we'd be seeing today?
Right, exactly right. So I think it's been a good run, and I think I think we're in the early innings. If somebody asked me what inning we're in, I'd say maybe the second.
Oh, wow.
Maybe the second inning. I think it's got a long way to run. It's because it's a great product.
It's a whole new world. It's going to be interesting to see what happens in the next few years. All right, well, Kevin, thank you for joining us today, and thank you for watching. For more information regarding the entire world of alternative investments, please visit www.adisa.org.